Hello value investors, thank you for joining me. Today I want to talk about my thought process into buying stocks. We're going to talk about market volatility, having a strategy that can see you through the long haul. And then we're going to talk about some interesting aspects including the power of compounding, and lastly the importance of really sticking with the strategy for at least a year to see how things work out. As you can tell, I've got a bit of a cold, hope you can see through that. So, when the markets are volatile, what people normally mean is the markets have been crashing for a while. That's what it typically means. And many cases, including Daniel Kahneman's, show that investors, when they lose something, it's much more painful than when they gain. So if your portfolio is down, let's say 5%, that's going to ring alarm bells in your head. If the portfolio is up 5%, business as usual. But we've got so much fear in investing that we're willing to disregard that over the long haul, if you're looking at, let's say, long periods of time, the markets just go up and up and up and up and up. Yes, they do have those periods where things go a bit kind of, and it's painful, and that's just part of how it is. If you think of it, the way I think about it is, when you're making a lasagna in the restaurant, you're gonna cut some onion, you're gonna cut some beef, and some of that's gonna go in the bin, and that's just part of how it is. Part of investing is there's gonna be periods of losses, and that's just the cost of doing business. So, if I look back to 2006, before the financial crisis, and to 2020, the S&P was up approximately 15%. So that includes the drawdown of 2008, 2009, that pain, the Greek crisis 2012, everything along the way, the Donald Trump election, everything that happened, the market has just been an absolute machine. Now, I'm not saying for one instance that 15% is a normal environment. I'm just saying that come what may, it has delivered that for a long period of time. And yes, it could now just be flat for the next 20 years. It could just go absolutely down a cliff and back up, but over a long period of time, like 20-30 years, markets do tend to go up. The economy keeps growing, so just have a plan that you can stick through it. The next part I want to talk about is really, I like to buy into what I call the hybrid portfolio. The hybrid portfolio is something that I came up with, which is half the portfolio is in high growth names. These are names that are going really fast. Something hopefully will come out of them in the future. And then I've got the other half, which is the traditional capital V value investing, which is low growth, high free cash flow, low multiple. That is something that I traditionally used to do a lot more. It's been quite difficult to do right now because markets has just been rewarding the other aspects, and that can be a discussion in and of itself. But I'm just telling you what I'm doing. So I'm nowadays I got the half with the hybrid, and I enjoy, of course, much more the value investing side of it, of just buying something that people don't really understand very well and buying something that generates a lot of free cash flow. But I understand, you have to recognize that you have to adapt. That's how Buffett survived for 60 years, a compounding machine, is that he had to adapt. He wanted to go from net nets to buying below book value, to buying stuff like Coca-Cola, to buying stuff like Apple. Things change. You can't keep using the same strategies that you learned about before and expect to outperform going forward. You gotta be in this and take it seriously. And you don't need to be as fanatic as I am, but if you want to be able to keep up minimally with the markets, you need to be adapting your strategy over time. Okay, that doesn't mean changing it every day, but you got to be able to have a strategy in your mind, and you need to think of what you want to be in the next 5 or 10 years. So, the power of compounding. I love this one. So, every investor knows the power of compounding, but I find it quite interesting, right? So, if you compound at 16%, over, let's say, 10 years. For the first 10 years, the portfolio's gone from 1 to 9. That's pretty great. And if you extend out slightly to, let's say, 20 years, it goes to approximately 18 times. But the last 5 years is really what counts. If you compound for 25 years at 16%, you're up 40 times. So it's really just that last little bit of the stretch. So I'm just, I've seen, if you're around this business, you kind of looked for countless tables of investing, of compounding, and that's quite normal. And I'm still so young at this. I'm still kind of so fresh at this that I feel like when Buffett looks back at general meetings, and he talks about the car industry in could have been in 1905 or 1910, I can't remember what it did now, and you just look at how disruptive capitalism is. That from that period there was like something like 2,000 companies just listed A and Bs, and you fast forward to today and it's like about so few companies that survive from that period, and it just shows you that over time how things move, and it's fascinating to me, the power of compounding. Finally, so this is one that I took away from The Psychology of Money, a great book. Strongly recommend you read it. Really short, but just filled with great ideas. So if you take any day in the US market, any single day, the market can be up or down. That's 50-50 chance you go into the casino betting on red. But if you extend that out slightly to a year's period, the market is typically up 68%. So if you go from 50-50 your odds, and you extend it to a year, your odds are 68% in your favor. That's just fantastic. It's like you keep flipping that coin, things are going to work out really well. And if you extend it to 10-year period, 88% the chance of making money. That's just fantastic. Obviously, nobody that is watching this video has the patience to really stick with it for 20 years. But if you happen to stick around for 20 years and do this, so far, 100% likely to make money. That's just mind-blowing. This is a game where you're like, you don't have to be the smartest guy in the room. You just have to be able to have the perseverance and study a bit of history, study a bit of Stoic history, study a lot of biographies and stuff like that. But if you just stick with it, the power of compounding is absolutely mind-blowing. So anyway, if you found this video useful, don't forget to check out my marketplace on Seeking Alpha. It's called Deep Value Returns. I'll tell you the stocks I own and why. Hopefully something that will kind of give you some inspiration, help you see things in a different way, and this kind of stuff and a lot more. Okay, I'll see you soon.